All right, so this is actually, we're gonna try to make up a little bit of time here, but I gotta say too, this is actually, of all the presentations I give in a given year, this is my favorite one. This is truly unique, bespoke insight, actual benchmarking data of how we're doing on our farm, how Lighthouse is doing, how you are all doing individually, and how we compare to just the broader farm group as all. So again, just kind of a fun, silly story to set this up. We're always trying to answer the question why. Why talk about benchmarking? So this summer I was out for a jog in the countryside and I ran past a farmstead alongside gravel road, and this little tiny Pomeranian dog, kind of like in this picture here, comes running out to meet me, high-pitched barking, won't leave me alone. I can't get it to like stop, and so I can keep on with my day. I can't get it to go back, and so I'm not sure what to do. If I take a step, it just follows me. And so I called my wife and said, hey, what do you think about this situation? She said, well, Dave, why don't you just walk 100 yards with the dog over to the house, and then just that'll solve this. And I said, well, I don't want to embarrass you with your ridiculous plan, but the big issue with that would be I may have to actually talk to someone then, and I don't want to do that. Here's what I think would be better. You know, I used to be big into running. I will just full-on sprint for a half mile. This Pomeranian will give up quick. I'll turn around. He'll be nowhere in sight. Problem solved. I'll go live the rest of my life, never think of this again. So that's my plan. I just hang up the phone and just take off running literally as hard as I can get my body to run full half mile to the next field line. And I get there and I'm hunched over. My lungs are in my throat. I can barely breathe. And I turn around and that Pomeranian is right on my ankles, as close as you can be. And turns out I cannot outrun a Pomeranian in an 800-meter dash. And if you'd asked me before that, if I'd asked you now, if you're thinking about it right now, you're probably actually thinking right now, I definitely could do that. He's not as fast as I would have thought, but I could do that. If you'd have said, I've never been so certain of anything in my life that I can outrun a Pomeranian in a half-mile sprint. But it turns out I can't, and I think that's what ties into benchmarking. We really just need to look at all the things we're doing, and are we actually doing a good job? What are we learning? What is this data telling us? So we don't just assume we're in the same kind of shape we were in 20 years ago. Okay, so criteria on this again, 2024 benchmarking, is that a misprint? Well, it shouldn't be 25. The crop year, so the 24 crop year just ended in September 30th. So the 25 crop, we're still wrestling with that together. It's not done yet. And we're looking at intentional hedges, actual hedges that we set out to do, not we ignored everything for the whole year and then just spotted our corn out, and then clients that did at least 75% of their grain as an intentional hedge. And a couple other takeaways. This is not a long jump contest. Like, just because you were first this year didn't mean you're the best at marketing grain. The whole goal in grain marketing, our whole objective is to price grain well and have peace of mind to run our farm well. So it doesn't mean that you have to be at the very top of this to be successful. It's not linear. It's not like a competition. So all those disclaimers out of the way, though, there's some stuff we can learn here. And then the other thing, our benchmark on this. What is our actual control data? So we started, this is year 4 of doing this. We've used North Dakota Farm Business Management. They've got public data. They report that. They share, here's where our farmers' average prices was. We expanded that to include Minnesota this year. So you now have several hundred farms in this control group. It should be a good cross-section of what the average farm is doing. So let's work our way from top to bottom on this chart. 2024 corn price benchmark results. Top 10% of Lighthouse clients, 503 average. This is futures price. Basis is not factored in. This is futures price adjusted to December futures. So 503 average futures on top 10%. That white squiggly line, that's December corn futures during the 2024 calendar year. Average of all Lighthouse clients, 477. Bottom 10%, 452. The control group, just the average of all farmers, or at least all farmers in North Dakota and Minnesota that are in adult farm management, was down at 413. So a couple things stand out. That top 10% of Lighthouse clients, their average price was higher than December corn traded at any point during the calendar year 2024. That involved hedges that were from way earlier to get to that number. And the average of all farms was 20% lower than that, and at a price that would have been tough to even achieve until you got into like the harvest window that year. If you had done any forward contracting, you would have outperformed that. So that's what the results were. We're not going to talk through beans. We're going to focus on corn as far as the takeaways, but just throwing soybeans up to see, you see a similar phenomenon. 1242 average price, higher than was ever tradable in calendar year 2024. 1140 for average, 1079, and an average of all farms down at 1073. So soybeans similarly, the average of all Leidos clients significantly outperformed the average of the market, and the top 10% was way above. So we picked apart this data, and there's some things we wanted to highlight where there's actual meaningful differences. Our flagship analytic, our signal score, our price signal, by far the most predictive analytic that we have. And when we started sharing this data 4 years ago, on this chart, we were looking at our top 10% had a signal score of 47, and our bottom 10% had a signal score of 37. That was really an indictment of us. Like, we were not even getting any grain sold at good optimal times. That was very reactionary. Low signal scores. The higher the signal, the better time it is versus this analytics to sell. So this year, all of these sales were being made with good signal scores into the 60s on average is really good. And actually, the bottom 10% actually had a higher signal score than the top 10%, but both groups had very good signal scores. So it wasn't signal score alone that determined who was in the top 10%, who was in the bottom 10%. And we wouldn't expect that it would be. All that signal score is this is a good time to sell. It's likely that price will be lower than this going forward over the next few months. So you can have price all the way up here and have a sell signal, and the price falls, and then it rallies a bit, and you have another sell signal. That's still better than selling low, but it alone is not enough to do a great job marketing. So then we said, what about our market gauges? And there's some things that stand out on market gauges pretty dramatically. Price to stocks to use. You're going to hear Andrew share a little bit here in 5-10 minutes when this wraps up. He's going to give our long-term outlook. He's going to center on some of this. The price of corn, the range that it trades in, is highly correlated to the projected stocks to use, more so than way more so even than soybeans or any other commodity. So you can look at what the government's projecting for stocks to use and draw a pretty good conclusion of what is the range that corn should trade in. So top 10% was saying, I'm selling when I got a sell signal, but also when that price to stocks to use gauge is high, where the bottom 10% was selling much lower. The average price to stocks to use market gauge score was nearly double on the top 10% of the bottom 10%. This will help explain why. Market gauge is seasonal. You have a strong seasonal component to grain, to virtually all commodities and most other classes of investment. And this chart on screen, that white line, that's the December corn seasonal over the last 16 years. And if you could actually draw that back to 30 years or 100 years or wherever it starts, and it would be similar. Basically what you have as a seasonal on a normal year is corn starts here, rallies through spring into early summer, falls into roughly September timeframe, and then starts the whole process over again. So certainly all bear markets tend to follow some version of this. Last year was no exception. Most bull markets do too. The only years that fall outside of this sort of transition markets, years like 2010 and 2020, where you transition from a bear market to bull market or vice versa on the other side. So the top 10% had an average sale date of April 10th, the bottom 10% October 4th. And if we break that down a little further, that top 10%, that's an average of the whole 2-year calendar window that they sold into. If we just look at the month, regardless of year, the top 10%, their average sale month was June, either June of 23, June of 24, or June of 25. The bottom 10%, their average sale date was 4 weeks after corn normally makes its seasonal low for the year. So now you're starting to build a further case on this. Now you know, if I want to be in the top 10%, at least for this last year, when the price signal's high, when the market gauge score for price to stocks to use is high, and when I'm in a seasonal window that tends to be associated with highs in corn, those are 3 things that will put me in a position to make a good sale, certainly. So we've got our fancy new classifier data that we're pretty excited about. We run that every morning now going forward into the future, but you can actually run that against any date in the past too. So when we do this on our top 10% versus our bottom 10%, again, the more negative that number is, the more that this classifier data is saying this is a good time to sell. That's saying, what would we expect the 20-day price change to be on all other days that were similar to this day? And the top 10% sales have a negative 9 cent expected price change. The bottom 10% only negative 2.7. So obviously this classifier data wasn't available then. It wasn't factoring into these decisions, but it's just reaffirming the point that even with the classifier data, hey, these top 10% sales were being done when analytics had a strong case. If we actually break that out further and just forget about individual clients and just take our top 10% of all sales, regardless of clients, just ranked every single of these several thousand contracts and ranked the top 10% and the bottom 10% of just the contracts, agnostic of which clients they are. The top 10% had a negative 13 cent expected change on classifier. The bottom 10% of all sales was negative 1 cent. And if you just think about this from kind of a wonky statistical standpoint, if I'm selling grain because I expect price to be 13 cents lower 20 days from now, that's a very much a positive expected value sale. If I'm selling grain and the classifier data is saying I expect the change 20 days from now to be negative 1 cent, you're not adding any value in that trade, or very over the long run. If you did that 1,000 times over, you would add almost no value on those negative 1 cent expected change trades. So that's a really important finding on this. So now we know top 10% and bottom had good sell signals. Top 10% high price to stocks to use. Top 10% right seasonal window. Top 10% classifiers saying this exact moment in time, we really think price is going to be lower 20 days from now based on how similar it is to others. So this is where we stopped the last 3 years. And I said, good enough, problem solved. And we're unpacking this further. We're like, man, this data aligns really well. Like, it tells what really well. It tells what the top 10% did different than the bottom 10%. We solved what really well with math. But it doesn't answer why. Like, this isn't just a math problem. This is a behavior problem, a behavior challenge. So we started to say, let's look into a couple of those things and see what we can learn. So when we look at behaviors, maybe not the right word, but it's the word that got typed into the slides, and then I got told I couldn't change the slides anymore. So we're using the word behavior. Demographics might be a better word. Something else might be a better word, period. But you can actually, if we look at the top 10%, the average farm size was nearly triple the bottom 10%. This is important that you don't miss what the point is here. This is not, a larger farm is better at marketing grain, or you have to be a larger farm to be successful at marketing grain. The opposite, marketing grain, like hedging, setting food, there's no advantage to scale. You could be the largest farm in the world, and you don't have any advantage on hedging your grain to the smallest farm in the world. What this data, I think, is actually showing is mathematical expression of something we experience pretty regularly at Lighthouse. I was in one of these conversations a couple of years ago where a prospective client reached out, and this was ahead of harvest. Price had fallen drastically, had all his old crop wheat in the bin. And he says, I want to work with Lighthouse. I got a neighbor that works with you. He's happy. He's saying that this is going well. So I started talking to him about how Lighthouse model works, all this stuff that we do alongside the client and whatnot. And he starts becoming visibly agitated. I was referencing, and here's where we sold wheat, and here's where we did this. Well, it would have been crazy to sell wheat. Everybody knew how bullish it was, and it's only this and that. And he actually kind of became upset about, hey, we did. And it became apparent quickly when it came to grain marketing, he didn't want less misery. He wanted more company. Like, he wanted to just have someone, this was an emotional decision, not an analytic one. He just wanted someone to reaffirm, hey, what you're doing is right here. Eventually, everyone that's screwing us in this market, it'll come around and be undone. And it's that mindset that it says you start drifting towards that. It's when you start making decisions that aren't analytic. When we think about the larger farms, they tend to be run more like a business. Like, I hired a merchandiser to consult with me on marketing. We're going to generally take their recommendations. I'm going to have a plan. I'm going to stick to it. I'm going to make decisions that are unemotional, that are analytical and whatnot. I think that's what this data is saying. It's not saying anything about what size your farm needs to be. It's saying, but you need to run your farm like a business. You need to make business-like decisions, professional type decisions if you're going to be successful there. This is probably the most important slide, though, in the whole deck. If you wanted to say, what happened to me on marketing in 2024 or 25, I want to change it for the better, it's this slide right here. So 10 as a Lighthouse client, top 10%, 80% of the top 10% have been Lighthouse clients for 6 years or longer, only 40% of the bottom 10%. So a lot of percents there, but basically you're twice as likely to have been a Lighthouse client for over half a decade if you're in the top 10% and the bottom 10%. Obvious thing there, right? Like obvious reason why. It's trust, just super high trust the longer that you've been with a Lighthouse client. Two-way trust. Trust from the client that, hey, what Lighthouse is recommending, it doesn't apply just to Lighthouse, it could be whoever your marketer is, but two-way trust. We trust, hey, we know what this farm's goals and objectives are, we can make these recommendations, trust that they act on them. And when we think about trust, you build it in two ways, competence and empathy. That's the formula for trust in any relationship, is a combination of competence and empathy. We, from the empathy standpoint, feeling like you do, understanding what you're going through, we solved that in day one at Lighthouse with how we set the business up. We get paid the same way you do. We're in it together, percentage marketing fee, no upfront per acre fee. So it's not an empathy problem. So we've put a lot of our effort into competence, all that stuff we talked about, market gauge, price signal, classifier data, et cetera, to where we can build out that competence. You know, it's interesting here. A lot of stuff ended up on the cutting room floor in this deal. A lot of stuff didn't make it into this presentation because there was no statistical difference. One thing there was no difference in, and this is in a way demoralizing for me because this is where I spend all of my time, or a lot of it, was there was no difference between the top 10% and the bottom 10% and how often they looked at Lighthouse's emails, videos, next trade segments, et cetera. No difference. And you're in one of two camps. You either look at everything or you look at nothing. There's no in between. You're either looking at every single email every day, every next trade segment, or you never look at any of them. And there was no difference. And it's about half and half. And it's the same on the top and the bottom. So I think that there's two takeaways there as it relates to trust. If you're in the top 10% of this, or just in general happy with your marketing, and you never look at anything, that's good. That means we have really high trust together and nothing needs to change there. If you're in the bottom 10%, that's something to maybe focus on a little bit, is just interacting more with the stuff that we're preparing to say, here's why we want to do this. All right, so this last one, just a quick takeaway on top 10% versus bottom 10%. If you were in the top 10% versus the bottom 10% in 2024, you were 312% more likely, over 3 times more likely, to have also been in the top third the year prior. Pretty strong evidence that those decision-making, behavior patterns, et cetera, that were putting you in the top in 2024, actually that can be replicated, that can be duplicated. It's not random, it's not just a one-off thing and whatnot. So this is something else the data says, that if we have strong trust, if we run our business professionally, like a business, don't make emotional decisions, prioritize all the analytics we talked about in the math part of this, that we won't just get good results in 2024, that we'll consistently be able to replicate those results. So again, just on conclusions here, I actually, this general arena, this consumes me. Like, I think every day about, and it applies to your farm too, everything we do, how hard we work, all the challenges, all of that, and just with no extra work, with no extra effort, no extra capital, no extra risk, no extra anything, just making slightly better hedging decisions, our business can just be so much better off, Lighthouses and the farm and whatnot. And I was struggling with how to conclude this and whatnot, and I actually didn't 24 hours ago. Right now, I didn't know what to say to just wrap this up in 60 seconds and whatnot, but then I actually spoke at a meeting yesterday in town, gave a quick market update. A few of you were there yesterday, no worries, it's not me, it'll be Andrew, it'll be new, and it'll be much better and more detailed and whatnot. But at the end of this, market update yesterday. A couple of farmers, and one in particular, they started raising their hand and asking questions. And this one farmer was all in the same vein. It was, well, the USDA report a week ago Monday was wrong. That corn data was wrong. That yield data was wrong. That acres increase was wrong. Everything about this was wrong. I don't know if it is or isn't wrong, but you could see that farmer in particular, their marketing plan wasn't, what's the signal score today? What's the market gauge? What's the seasonal? What's the classifier data? Do I trust the people that are giving me this advice? Do I have a system and approach to make decisions? Do I do this professionally like a business? Their whole marketing plan was, I'm in love with this grain, and I think it's worth a fortune, and anyone that tells me isn't is obviously lying, and I just give it enough time, that price will come to where I want it to be, and just strictly emotional decision. And the more you can move away from that, the more you move away from that 413 all-farm average, and the more you move higher and higher up on this slide. The data makes that abundantly clear. So that's what we learned in 24 benchmarking. We're still in this making up time thing. I can answer a question or two quick here while Andrew makes his way over. Otherwise, we'll go right into the market outlook here. So. Oh, yeah.
So I'll ask a question. So do you ever look at which merchandiser has the people that are in the top 10% and how?
Question was, do you look at merchandiser that has how it ranks out from merchandiser to merchandiser? And we do. We just started looking this year. I don't have anything to say on it right now. So, yeah. Yeah, I will say, and that's a phenomenal question, because that wasn't what I was planning on talking about here, but that is the next progression of this internally. Is there differences among merchandise? If so, why? Are we communicating message, et cetera? Yeah, this is a total obsession. When you think about all that AI work that we talked about, that's freed up a whole bunch of my time. This is a total obsession. We just think about the difference between the average farm price and the top 10%, the average of all, not the average of Lighthouse, the average of the control group and the top 10%, that's hundreds of thousands of dollars to our bottom line and whatnot. There's nothing else we could do as a company than to help you and I market this grain better. So yeah, as far as how I'd answer, absolutely looking at that and a whole bunch of other things internal that say, what are some meaningful differences and whatnot. So that's actually a really, really good question that I don't want to answer in more detail than that. So, yeah.
The adult farm management numbers, I don't know that those are actual.
So,
those are numbers that the person that's in the program says that his crop is worth when he goes through his numbers.
yeah.
And their basis inflicted where yours are not.
So,
Is that true?
no, and Jory can speak on. Yeah. Average basis is backed out of that, but you are right about like your unsold inventory at the end of the year, they would be plugging whatever they wanted to call it on that. So, but if you carried inventory into 2025 and then you called, Lighthouse at the end in September and said all my corn from 2024 is unsold and you're lower still then and whatnot. So, but all right, well. We'll have a lot of social time throughout the day and whatnot. I'm happy to go deeper in this one-on-one and whatnot, but we better get you talking markets here, Andrew.